Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 333 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including a 2026 market outlook, major asset class returns for 2025, research related to stock market volatility, and S&P 500 earnings research. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. Nick, good morning, my friend.
Good morning.
For those that don't know Nick, if you're not a regular listener, Nick is our Director of Research and Trading here at the firm. Nick Whitaker, absolute rock star, and a friend of mine.
I don't know if I'm a rock star, but I'll take the compliment. I appreciate it.
And your hair's looking extra good this morning, my friend.
All right.
He always has great hair. Mr. Whitaker, you want to do pricing before we get into headlines and current events?
Yes, as always, for our regular listeners, we run through pricing right at the beginning of the call just to check in on the markets. This data is coming as of yesterday, 1/7/26, and this pricing is from Y-Charts. The S&P 500 is up 1.1% month to date, and I'm not going to read the year to date because it's going to be all the same.
All the same.
So we'll just stick with the month to date.
It makes it a little easy this month.
It does, yes. The Dow Jones is up 1.9% month to date. The NASDAQ Composite is up 1.5% month to date. The iShares Russell 2000 ETF, think small caps, is up 3.8% month to date. Interesting.
Very.
Vanguard FTSE All World ex-US Index is up 2.4% year to date, so still seeing some strength in international markets. Checking in on the Treasury rates, our 3-month Treasury rate is sitting at 3.62. The 2-year Treasury rate is sitting at 3.47, and the 10-year is sitting at 4.15%. Any comments before we move on to big headlines?
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. I'm really kind of focused. I'm dialed in on that 10-year right now. You know, I think that based upon CME interest rate futures this year, I think the market's expecting 2/4 point cuts. And that's a general statement. Very kind of, the data could go either way.
Of course.
But right now, generally speaking, 2 cuts. I think if I had to throw it out there, I think we're going to have more than 2 cuts this year.
Okay. In the more than 2 cuts camp.
I'm in the more than 2 cuts camp. I am. How about you?
Last year, I was in the camp that we weren't going to cut rates as much. I was more in the 1 cut last year.
Okay.
This year, I think I'm in the we'll see more. I do.
You know why I'm also
I think
saying
we'll see above whatever the consensus is. So, yeah, if we got to 3, that would not surprise me.
I agree. When you look at, there's a independent research firm out there called Trueflation. I've talked about them in the podcast before. They replicate the consumer price index basket with real-time prices. We can get into that in a different day because a lot of the CPI data the government uses to create that index is laggy. The data lags a little bit. But Trueflation right now is showing year over year replicating the same basket is actually just sub 2% right now, like 1.98, 1.99.
Right.
That's why I'm saying it.
Which gives the Fed a little bit of wiggle room to cut rates to help with other parts of the economy for those who need us to connect those dots there.
That's right. And let's say the jobs number, which I know you might talk about this here in a second, comes out a little light, say tomorrow for December, that adds more fuel to the fire, baby.
Absolutely. Absolutely.
Good segue. Why don't
Yes.
you want to tackle big headlines and current events? We got some bangers this week.
Yeah, per usual, Matt and Nick are already off on a tangent right at the beginning of the podcast, so we'll try to stay on track here. So big headlines. Obviously, the biggest one that everyone is well aware of at this point was the New Year getting off to a pretty excitable start from a geopolitical standpoint as the U.S. military forces went into Venezuela and captured Nicolas Maduro and his wife. Obviously, that's a pretty big shakeup from a geopolitical perspective and international policy and everything that comes with that. However, as you just heard us on the podcast just a second ago talking about pricing, the equity markets are pretty unfazed.
Yes, that's a good way of saying it.
Which I wouldn't say is necessarily a surprising thing. We see that often with international conflicts because, as I'll talk about later, often the market is focused on profitability and earnings, and as sad as that is to say, international conflicts don't always impact the bottom line.
I have nothing to add. You said it perfectly.
The other big piece I want to check in with listeners, and I'm sure those who follow the pricing and follow the podcast will be anxious to hear about the Santa Claus rally update. Unfortunately, the Santa Claus rally did not occur.
Nope.
So the Santa Claus rally, for those who are not aware, is the last 5 trading sessions of 2025 and the first 2 of the following year, 2026. If those result in a gain, it's typically a good sign for the market. If not, then that can kind of put the market on some shaky ground from a historical, statistical perspective.
Well said.
That doesn't mean that that's a guarantee. Anything can happen, as always, with the markets. So the next big thing is that
trading
investors
folklore.
Yeah, exactly. Trading folklore. The next big thing that people will be focusing on is January and where January ends.
Yep.
There's a saying that as January goes, so goes the year. So if
Well
January is down, then that will be kind of another negative statistical feather in the cap of the bears, let's say.
Yeah, that's good said. Well said. Yep.
And then lastly, there's some market events coming up, as always. On Friday, be on the lookout for a possible Supreme Court ruling regarding President Trump's tariff authority. And then there will also be a jobs report that's due out on 8:30. So there's
8:30 a.m.
8:30
East Coast time.
Eastern. So there's going to be some market moving headlines on Friday morning. So be aware of that. Could see some volatility.
Let's help our listeners and viewers translate this employment data the way the market is going to translate it. So ADP came out on Wednesday, and they try to utilize their broad scope to estimate private payrolls for the country.
Mm-hmm.
And their estimate was somewhere in the range of the mid 40,000, okay, is what they are estimating on the private side. Sometimes this number is very accurate, and sometimes it is not, right?
Yeah, it's more of a tertiary data point that kind of leads up to the main jobs report.
Well said.
Because the data is a little less all-encompassing. So sometimes you get some outlier data that is just...
Yeah, not everyone uses ADP.
Right, exactly.
Right? The point I wanted to make on this, from the lens of the market, if that jobs number is really strong, and this will seem a little counterintuitive, that's actually bad for the stock market in the short term. Why? Right. The market wants cheaper borrowing cost. Yeah. And if that jobs number comes in light, what does it do, Nick?
It means the Fed needs to sit on their hands for a while, which means that rate cut expectation that we talked about, you'll see some shifts in there, maybe to the other way. I'm not saying that would necessarily move the entire year of saying 2%, but statistically speaking, the probabilities on 2 cuts and 2026 will shift towards a lesser possibility of that if we get a really strong jobs report.
There it is. And if it's a weak jobs report, all of a sudden the Fed has more ammunition to cut more, lower interest rates. Yeah. So I think it's important that our listeners and viewers understand sometimes that strong economic news initially could be bad for the market on a shorter term basis. It kind of seems counterintuitive at times.
And that is often the case throughout equity markets and just throughout the year, that it's often that there are times where it flips, but that's typically whenever the market needs some type of action to slow down an overheating economy. So that's when you kind of you kind of see a flip flop.
Yeah, good news is bad, bad is good.
Yeah.
You start going through those type of moments in the market, and a lot of investors are like, this doesn't make sense.
Right. It can be inverse. So yeah, good jobs report. Can expect some weakness in the market.
Correct. Well, let's pivot. It's the beginning of a new year, and I would like to start off, Nick, with my 2026 outlook. This outlook is a list of potential investment themes and topics to watch, in my opinion, for this calendar year. I think that these are the topics that could drive market volatility, sector rotations, and portfolio strategies. You buckled in?
Oh, yeah.
You ready?
I'm ready.
Let's do this. First, probability of a government shutdown and Supreme Court related rulings. So we need to be aware that an imminent shutdown threat as of the end of this month in January is very real. After a 43-day shutdown in late 2025, Congress passed a short-term continuing resolution funding most agencies only through January 30th of this year. Negotiations on the remaining 9 appropriation bills for this year have stalled. Hardliners are pushing for cuts, while unresolved issues such as health premium cost, federal workforce protections linger. A failure to pass a full year bill or another continuing resolution could trigger another partial shutdown. That could lead to short-term yields getting higher, disrupting federal payments and contracting, adding risk premiums to bonds, etc. So my comment here is my personal opinion of the probability of a shutdown of the government sometime in February is very high, in my opinion. Any thoughts before I go to the Supreme Court?
No, I agree. I think it's extremely high that the government shuts down again. At least I'm not going to say it's going to be a 43 record shutdown. Hopefully not. But I think we'll have a small shutdown.
So this will be the headlines you're going to be reading and experiencing in February.
Yeah.
Next, you have obviously the Supreme Court arguments. Later this month, you got Trump versus Cook. That's the presidential power to fire Fed governors. That's a direct tie to monetary policy independence. That will be some headlines on that front. You got the tariff stuff you talked about coming in short order. It's very possible they come out and say, hey, we're going to delay this decision, right? But just know that these are going to be some headlines between the government shutdown and Supreme Court. You're going to have that, and the market's going to pay attention.
In the Supreme Court one is, in my mind, that one sticks out a little bit more. I think that has some massive implications towards what the rest of the world sees as a safe haven with the Treasury bills. So the rest of the world will be watching that very, very closely.
Well said.
And the investment community will be watching that very closely. And it all has to do with confidence in the Federal Reserve's ability to be independent and monitor and take action appropriately to help the global economy move consistently so that you don't have these massive swings in the global economy. And as the international community loses confidence in that, it can create more volatility.
Yeah, well said.
Is that fair?
Yeah, that's very fair. Yeah, well said. So my second item is new Fed chair and interest rates for the year. So let's dive into this topic, Nick. Timeline of this transition. Jerome Powell's 4-year term as Fed chair ends May 15th of 2026. His broader governor term runs through 2028, but he's expected to depart fully in May. President Trump has signaled a nomination announcement as early as January here in 2026, potentially, with frontrunners including Kevin Hassett. He's the NEC director and supposedly a Trump loyalist. Kevin Warsh, he's a former Fed governor. Christopher Waller, a current Fed governor. And even others like a Michelle Bowman. Senate confirmations could wrap up by spring, positioning the new Fed chair to lead the June FOMC meeting. So just want to throw that out there. You're going to have headlines this year, a new Fed chair, new influence on that. trying not to get into personal politics. I think it'd be no secret and no surprise, no matter what aisle your political beliefs are on, that Trump will most likely nominate someone that has some of his viewpoints on this topic. Is that a fair way of saying it?
Absolutely. I am not as familiar with Warsh, but I know Waller and Bowman have been very much in on the right side. Basically, anyone that Trump's going to put in there, he wants to put in that is going to put more accommodative policy in place.
Well said.
So, and that's one of the reasons probably that I'm guessing that you're saying you could expect to see more than 2 cuts this year.
It adds to my old Ben Franklin positives and negatives. Definitely adds to the positive, in my opinion, right?
Exactly. And that's one of the big things for me as well. So I think you can expect the Federal Reserve Chair Fed, whoever is nominated, to be more in lockstep with communication from the White House.
Well said. And then market expectations for policy under new leadership. Wall Street in general has forecasted limited Fed cuts for this year, perhaps no more than 2 cuts, landing the Fed funds rate, around 3.5% to 3.75% amid sticky inflation above 2%. However, we got to realize that some of the more real-time indicators are saying that we're actually sub 2%. So we'll see how quick the laggy CPI index by the government catches up. So again, to summarize, new Fed chair, interest rates, that's going to be a topic and theme that the market's focused on as the year goes on. Next, the renegotiation of the USMCA. You're going to see a lot of headlines on this later in the year. I'm going to forecast it to you right now on the Independent Advisors podcast. So the USMCA enters its mandatory joint review on July 1st, 2026, 6 years after entry into force, where the U.S., Mexico, and Canada must decide whether to extend the agreement for another 16 years to 2042 or trigger a countdown to terminate in 2036. President Trump has signaled to intent to leverage this review, potentially withholding U.S. renewal approval to push for partial or comprehensive renegotiations focusing on tightening rules of origin, especially automobiles, curbing Chinese transshipment through North America, addressing migration drug flows, and resolving ongoing disputes, with USTR's detailed report to Congress due imminently here in January, outlining the U.S.'s positions. Formal bilateral and trilateral talks are expected to ramp up soon after, creating uncertainty for integrated supply chains. So in summary here, I know tariffs have got their fair share of headlines in the year of 2025. And for the most part, a lot of tariffs are established, and there hasn't been a lot of change. I'm going to throw it out there the last quarter or two. It's been pretty consistent since last summer.
Yep.
This trade talk, especially with the USMCA, is going to come back front and center. I think you're going to see a lot of headlines about this in the late spring. Just know it's coming. Any other comments, Nick?
It's really big for autos from when you get down into the data and how that impacts auto is a big section of this. And,
that's an excellent point.
Yeah.
And there was a message yesterday from the administration. If I could read this real quick.
Yeah, absolutely.
It's in regards to this comment. Yesterday, this is from the Treasury Secretary. Treasury is implementing President Trump's note tax on American car loan interest, it says, Nick, putting money back in the pockets of working and middle-class families for U.S. assembled vehicles purchased in the years of 2025 through 2028. Eligible taxpayers can deduct up to $10,000 per year in auto loan interest. This is in addition, if you read a little further, to your standard deduction.
See, that kind of, those kind of regulations and tax changes that can pretty drastically shape consumer spending to move more towards U.S. vehicles.
Absolutely.
And so those are some of the kind of things.
Kind of reminds me of the late 2000s GFC cash for clunkers. You remember that? Remember that? Cash for clunkers?
Yeah.
Very, very catchy.
Yeah,
Very
it's
catchy.
Yeah.
But this is I think this is good. If you work or you're a supplier in the automobile industry, that's not bearish news.
No, not at all.
You know, there's a lot of people who might, hey, interest rate's still a little high for a car, but you know what? I get to take it off my taxes.
Yeah.
You might have that thought process. All right, next, midterm elections. No surprise, but we got to talk about it. The November 2026 midterms will serve as a referendum on President Trump's second term, with Republicans defending narrow majorities. So let's talk about this. Currently, the majority in the House is 219 seats to 213, and in the Senate, it's 53 to 47, okay? Historical patterns show the president's party often loses seats, amplified here by economic concerns of lingering inflation, tariff impacts, and rising health premiums. So before I continue, I'm going to say it a different way. And we've talked about this last year on the podcast in 2025 several times. There hasn't been an instance of an incumbent party that controlled the presidency in both sides of Congress that has held on to it in the midterms. Didn't happen to Obama. It didn't happen to Bush. Go down the list. You know, statistically, it's going to be very hard, I think, for the Republicans, just looking at the lens of history, to make that happen. Okay? Now, key Senate battleground states are going to be Georgia, North Carolina, Michigan, and Maine. Those are going to be what a lot of pundits are throwing out there, Nick. Markets historically see heightened volatility in these midterm election years, with underperformance pre-election due to policy uncertainty, followed typically by strong market rebounds post-election into the end of the year as clarity emerges. So we just got to know that going into 2026, when you slice and dice the stock market on the 4-year presidential election cycle, year 2 historically has the lowest returns. Before I move on, any comments, Mr. Whitaker?
My only comment would be kind of echoing the heightened volatility around midterm years. Between the midterm year and the statistical analysis that we have around that, plus a lot of these other themes that we're talking about, I would expect to see more volatility this year relative to last year. Last year, there was obviously the really big sell-off in April, and that was the big volatility event, so one big volatility event. And then really for the rest of the year, it was a little bit more stable, a little bit easier, slow trend up, right? I would expect this year to be a bit more choppy and a bit more volatile throughout the year, if that makes sense.
I am on the same page with this, and I agree wholeheartedly with that.
Yeah. So I would just encourage investors and listeners to be aware of that and, stick to your long-term plan. Don't panic.
Well said. That's going to be normal this year.
Yeah.
Expect that. Number 5, Venezuelan energy revival and Latin American geopolitics. So here, obviously, the U.S. push for American firms to invest billions in overhauling oil infrastructure in light of Maduro's ouster, let's call it, potential for boosted production and lower long-term prices of oil. Again, you're going to have volatility. You're going to have a lot of geopolitical conversations about migration, defense, OPEC dynamics start coming into play with oil. That's going to be a whole topic as the year goes on. Okay?
Oh, it sure will.
Yep. Number 6, AI infrastructure boom. So again, we have this continued, data center build out. Chip demand is going to be looked at very closely as the year goes on. The power that's needed to drive these data centers, that's going to be a topic as the year goes on. Your thoughts?
I think this is another big one that obviously was at the forefront of last year's themes, if you will, probably the past 2-year themes.
Yeah.
But I think this year might be the first year where we start to see what the real demand might be and how much excess supply we have in these data centers. And the initial readouts could cause some volatility. And what I mean by that is, okay, we're building out these massive data centers. There's a few in Texas, for example, and we're trying to forecast the amount of demand that society is actually going to soak up from using these AI products. Obviously, they need more bandwidth in the data center. So let's say, midway through the year, we get some initial readouts on, understanding a little bit more of like what is this actual demand going to be, and how do we translate that into profit. And you can see some volatility around that because there's a lot of resources and a lot of debt has gone into building out these facilities. So, if there's a difficulty understanding exactly how we're going to translate X amount of demand into Y amount of dollars, you could see some volatility around that. So that another tip in another feather in the cap of volatility, I would say.
Yeah, that's well said. If you go back to 2025, as you insinuated a couple seconds ago, Nick, and you think about November, the market was really debating where we were in this spending cycle on these data center build out along with the AI trade. I still think that we are in the arms race phase, but as you indicated, is it going to be this year or is it going to be next year where we go from we need to build it and they will come to the aspect of is the capacity now too much? We've overbuilt. Is that a 2026 theme? Is it 2027? Is it 2028? We don't know, but that will definitely be a topic that the market is going to analyze. And it gets a lot of data points, especially during earnings season.
Right.
So coming up here at the end of the month, you're going to get earnings from a lot of these tech names, and they're going to be slice and dicing the numbers to say, are people still spending a lot? The other aspect I want to throw out there is just some local news here in Southwest Ohio. In the past roughly 3 months, they announced a huge data center build. This one I'm going to talk about here is Amazon, north of town, about an hour north of Dayton. And then after that was announced, they announced that they were going to build one south of Dayton, about an hour south in Wilmington, Ohio. And I read yesterday where residents in Wilmington went to the city council, and it was a little bit of a NIMBY situation, not in my backyard. Residents were wanting information on how it could affect groundwater, sound. Like there was a list of things.
Sound is a big one.
Yes. And, they're going to have to, the likes of Amazon, Microsoft, go down the list, Meta, Alphabet, they're going to have to figure out how they're going to start combating NIMBY. If that makes sense.
Yeah, I think that's a big. This one is this theme is not going to go away. I do think, as you mentioned, you'll see kind of that build out. And is it too much? I think that's going to be more 2027 and 2028. But I do think there's going to be a couple stories.
Oh yeah,
and there's going to be a couple of themes and a couple of stocks. We already saw it a little bit last year with a few names.
Yep.
And so I just expect to see a little bit of a couple of themes, if you will.
Well said. Next, power and energy transition demands. Obviously, we have a surge in electricity needs for things like AI, electric vehicles, manufacturing, reshoring. Again, we need to have some power grid upgrades. There's just a lot of topics on the power side of the equation. You got a lot of pushback to get nuclear capacity going again on the upswing.
Oh yeah. That's a big story.
You got the NIMBY with all these topics.
Yeah. This is very closely, in my mind and the market's mind, very closely related to the AI infrastructure.
I would agree.
Yeah.
I would agree. One other topic, and this is more, I think, a political topic, but it needs to be said, in my opinion, power cost. As you're seeing in some of the regions around North America, where there tends to be a concentration of these data centers, the residents are starting to see some disproportional rises in their kilowatt energy cost.
Yep.
We live in a world, Nick, of supply and demand. Number 8, global defense and security spending. So rising budgets amid U.S. foreign actions like Venezuela, plus cyber threats favoring aerospace, arms, and tech security firms. For the record, I prepared these notes earlier this week. And then yesterday, some of the headlines from President Trump is he's going to be pushing or proposing Congress raises the budget on the Department of Defense, Department of War from roughly, these numbers are insane, Nick, $1 trillion to $1.5 trillion on an annual basis.
That's a massive boost.
So we'll see where that goes. Again, I'm just throwing out the themes and the topics that are going to be discussed this year that stock investors are going to be facing.
Yep.
Next, supply chain resilience and regional alignments. You talked about a little bit ago, the USMCA, you got that's going to be debated. You got accelerating nearshoring to Mexico and Canada from other parts of the world. That could be boosting logistics and industrial sectors. That's going to be watched. Any comments before I move to the next one?
No comments on that one.
Number 10, M&A, merger and acquisitions, a surge in deal-making revival. Easier financing and policy shifts under potential new Fed leadership may spur corporate consolidations, especially in tech and energy. So I think this is going to be a year where I'm going to come in on a Monday morning. They typically get announced on Sunday nights or Monday mornings. I'm going to come in and XYZ bought ABC, and then the implications for the rest of that industry, right? I think we're going to have a couple of those good ones this year. You got companies like Warren Buffett sitting on over $300 billion of cash. I think we might have a couple blockbuster deals this year. Your comments?
My comments are I agree with that. And another reasoning would be because of the Federal Trade Commission and the government bodies that monitor the acquisitions and can break them up. I think there are limited resources, and you see fewer and fewer deals getting kind of stopped and broken up.
That's good analysis,
and
yeah.
So I think that opens it up for tech firms to consolidate.
Yes.
I think if we were in a bit of a different government and social environment, perhaps, that it might be my opinions might be different, but I just don't think there's going to be a lot of regulatory pushback, if that makes sense.
No, I think that's well said.
Wherein maybe
less, at least.
Less, where maybe like a decade ago there was more.
Yeah, I think you're spot on. Number 11, bond market resilience and safe havens. You got the Fed transition, shutdown risks, geopolitical jitters like Venezuela could keep yields volatile, favoring treasuries, gold, diversified fixed income go down the road. A lot of eyes are going to be in the bond market. I think another thing that's going to be, front and center is there's a lot of states that are hurting financially right now. And I think some of these states that are hurting the most are going to have to show some financial discipline. You can't just keep going back to the bond market if they're not showing discipline. So that's a conversation for another day. But I expect the bond market to be equally as volatile as the stock market. Nick, is that a good way of saying it?
Absolutely.
So number 12, S&P 500, earnings per share growth and equity valuations. So right now, the Wall Street consensus, Nick, is somewhere between 12 to 15% earnings growth for the S&P 500 index from 2025 to 2026. That's not bearish, buddy.
No,
that is not bearish. Remember, that's a forecast. Not saying that it's going to happen. That's Wall Street's consensus. But high valuations may temper returns. So we got to remember that there's still some arguments from certain people on Wall Street that valuations are on the higher end. But, don't try coming at me and telling me that earnings aren't following, because that was the bears narrative last year and how'd that turn out for you?
Right.
Okay. So, a broken clock is right twice a day. At some point they'll be right. They'll be spiking the football. But I would argue the opportunity cost that they endured waiting to be right wasn't worth it. That's obviously, I'm talking my book and my position and how I manage money.
Sure.
But it's my version of spiking the ball. Okay. Number 13, American consumer resilience in jobs market. Entering 2026, the U.S. consumer remains resilient overall, with personal spending powering much of the economy's growth in late 2025. That's driven by strong gains in services, experiences like travel and events, and wealth effects from equity markets benefiting higher income households. But a pronounced K-shaped pattern persists, Nick, with lower and middle income groups showing stagnant or slowing spending amid tariff-induced price pressures in wage moderation. Let me continue before you react, if I could. A key dynamic to monitor throughout 2026 is the extreme concentration of spending power. We've talked about this in the podcast before. Let's give a reminder. The top 10% of income earners, that's households making over $250,000, now account for nearly 50% of all consumer spending. That's the highest share on record since tracking began in 1989, Nick. Fueled by surging stock portfolios, home values, while the bottom 80% have seen real spending growth stall or decline. Thoughts, comments? I'll give you the first go.
This has been a big theme the past year and a half. Particularly in 2025, this was a big one, and we just saw headline after headline, at least on the research side, you could say.
Yeah.
It's going to continue to be a theme, and that's why I think the jobs report, as we mentioned at the beginning of the call, will be important, and seeing what the Fed does, and basically keeping the economy healthy, and not having a big economic event.
Yes.
If that makes sense.
It does.
That will help kind of keep consumer spending up, because the concern here is if that 10% slows down spending, if they're accounting for 50% of the spending and you already have a big section of the economy that's pulling back.
Keep going.
That's where the economy can really start moving south quickly.
Preach, baby.
So that the government, the Federal Reserve, will be very focused on trying to keep that spending up, because that's what keeps the economy healthy. And if the spending goes down, it's going to be bad for everybody, not just the people who are already slowing down spending.
Boom.
And I don't say that to be insensitive. I just say that to be an analyst.
That's just and I agree with everything you said there. Yeah. You said it perfectly. Yeah. Before I transition away from these themes and headlines that I think will dominate investors' thought process as this year goes on, I'm going to throw out my black swan event as we transition.
Ooh, fun.
Okay. The number one, in my opinion, black swan event that the market needs to be monitoring is China and Taiwan. As you've mentioned, the geopolitical shakeup that the administration, and there's so many layers to what the administration is doing with Venezuela. So many layers on this one. If you really spend time dissecting it, I want to throw it out there where market narrative could shift is depending upon if China tries to make a play on Taiwan. I'm not saying they are. I'm just calling this the black swan topic that the market is not pricing in right now. That is something I think investors need to monitor. So far, the Chinese response regarding Venezuela has been very quiet. That's telling within itself. So I just want to throw it out there. I would not make it a heavy part of your investment thesis, because I could sit here and list 20 black swan events. And if we spend time focusing on all the potential black swan events of the last 20 years,
you would never invest.
You would have never invest, and you wouldn't ever make any money. Okay. So I just want to caution people, but just want to throw it out there. I'm going to be monitoring the actions of China as the year goes on. That's going to be something I'm going to be watching.
For listeners who are not aware, a black swan event it's just financial jargon, Wall Street jargon for some type of event that you could literally, you couldn't predict the timing. You don't exactly know.
It's not priced into the market.
And historically speaking, when you look at what are quote unquote black swan events, they're big events that actually impact the pricing of markets. Right?
9/11's a great example.
9/11's a great example. And again, it's things that you can't really plan for.
COVID.
You can't set up an investment portfolio planning for black swan events, because to the point you just made, you would always carry too much cash and you would never be in the market, and you would
Purchasing power in your assets would erode.
Yeah, you would set
inflation.
yourself up for failure in the long run.
Exactly.
So that's what a black swan event is.
Thank you for that. That was nice.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
I'm going to do this real quick. I'll turn it over to you. Interesting stat caught my eye from Subu Trade. The timestamp on this, Mr. Whitaker, is January 2nd. He had a data point about S&P 500 after 3 months at the end of each month where it closes, the index value closes within 1% of each other. Okay? So over the past 3 months, the S&P 500 has closed within an unusually tight 1% range, Subu Trade said. 68.40, 68.49, 68.45. Historically, when the S&P compresses like this for 3 consecutive months, it was almost always higher 2 to 4 months later, says Subu Trade. I'm going to look at the data set here. Remember, these are just historical data. This does not guarantee anything in the market. But when the market has such a tight trading range at the value at the end of the last 3 months, on average, 3 months later, the stock market, there's about 15 data points on this or so, Nick? 19, 50, 55, 59, 59, 64, 64, 65, 68, etc. 3 months later, on average, up 6% with a 94% positivity rate, and 12 months later, on average, up 13% with an 83% positivity rate. The years it was negative 1 year later, in case you are driving and thinking about that data point, there was a time in 1959, 1965, and 1972. Okay. Most recent data points where this happened in recent times, there was a time in 2006, 2011, 2012, 2016, and 2017. Interesting.
Very.
Just a data point. Mr. Whitaker, what do you got for listeners and viewers this week?
So, given our run through for the year, which I hope listeners found very helpful, I just have one. And the one I have here is just touching in on major asset class returns for 2025.
Oh, this is going to be juicy.
And this is a research piece. It's picked up from a weekly research piece from Callum Thomas on 1/4/2026.
He always produces great charts, man.
Yeah, he and his team do great stuff.
We had him on the podcast several years ago. It's been a while. It's been a while. And he's blown up since then. He's a household name within the Wall Street community, I would argue, from a research standpoint.
Absolutely. So these are pretty simple charts. It's just a performance-based chart. He says the total return for the S&P 500 of 17.9% placed U.S. large caps in the upper half of asset class return tables, but materially lower than global equities, with frontier markets boasting the best returns and oddly even EM local currency government
emerging
bonds.
markets.
Thank you. Emerging market local currency government bonds outperforming versus U.S. large caps. So I think a lot of times and U.S. investors are very focused on the S&P 500 and the Dow and the NASDAQ, as they should. That's one of the leaders of the
global markets.
Of global markets. That's what we think of when we talk about Wall Street and the street. But there are other asset classes, and so I just thought this would be an interesting one to see if you have any comments on what you think about the frontier, emerging markets.
I have a strong opinion on this topic.
I thought you might.
Nick knows me well, listeners and viewers. He knows how to poke the bear. So my thought on this, it brings me back to a piece I talked about on the podcast, and Jenna might be able to collaborate with me on this. About a month ago, I talked about the dollar strength, and it was comparing the performance of the American dollar versus a basket of foreign currencies in Trump's first term versus how it's acted so far in his second term. And if my memory's right, Jenna, it was about a month ago. I had that, maybe mid-December, okay? And if you look at the lens of history, Nick, the dollar tends to begin strengthening sometime in the first half of that second year. That's kind of where we're at now. Mm-hmm. And everyone who was overweight international right now is walking around with their chest puffed out, thinking that they got it all under control. Mm-hmm. How's it going to be when the dollar starts strengthening again? Mm-hmm. That's my comment. And if you are an individual that is overweight international, that needs to be a serious topic of focus and consideration. Because I would argue, if the lens of history repeats itself, and the dollar starts strengthening, you're going to go from a pretty major tailwind to a pretty strong headwind. Mm-hmm. So I want to throw it out there. And I think right now, America in general has a lot of positives on its side. Mm-hmm. So I would be careful, in my personal opinion, because of those factors. Your thoughts and comments?
This to me, and your comments around the dollar and thinking about that from an international investing perspective, I think a lot of this circles back to what we've talked about a couple of times with 2026 and thinking about the Fed and the new Fed governor and what that can do to the confidence of the Federal Reserve, and if there's a little bit less headlines of angst between the White House and the Federal Reserve, and there's a little bit more confidence in the Federal Reserve as somewhat independent, if you could say. There's just been some headlines and the international investing community kind of pulling back, which is why you're seeing the dollar weaken and gold prices kind of move higher. Mm-hmm. And so I think if that story kind of can resolve itself, you have some of these headwinds you just talked about, that's another big headwind, tailwind for the dollar. That's another big tailwind, and that's one of the big points that I think could slow that movement of international pricing power.
Yeah, I mean, I could throw it out there. My really, really hot take on the topic is our interest rates, our short-term interest rates, I think on a global basis for very developed countries is still really attractive. Mm-hmm. So, I know it might sound like a hot take for those that are really kind of watching things closely, but guess what? We're the cleanest shirt in the closet.
Yeah. And our interest rates are poised to get more attractive, right?
Yeah. Yeah. What else you got, Nick?
That was everything I wanted to cover today with our comments on our time on 2026 and a little bit of review on 2025. So hopefully listeners enjoyed that.
Again, we're previewing these themes and topics I think that are going to evolve as the year goes on. I'm not coming across that I have all the answers on these topics, but rather these are the things that the market will be responding to and monitoring. Right, Nick?
And we will certainly be returning to these topics as they are timely throughout the year, as we always do.
So before we sign off, I want to throw it out there. Earnings season is going to be heating up the next couple of weeks. Mm-hmm. When we say earnings season, that means publicly traded companies report their earnings to shareholders every quarter. Mm-hmm. And coming up here, a lot of companies will be reporting their Q4 2025 earnings. Between the middle of January and the middle of February is the bulk of publicly traded companies. In addition, because of the timing of where we're at with the calendar, Nick, there will be some companies that also provide their estimates or their forecasts, their outlook for the entire year as well. That is common for a lot of publicly traded companies. With that being said, if you see some larger volatility on some individual securities over the next 4 weeks, most likely they just reported earnings and the market is reacting not only to how they did in the fourth quarter, but their comments about real time and their estimations and outlooks for the next quarter and or the year. Any other comments on that?
Yeah, simply put, you could see some reaction for individual stocks. You could also see some movement between sectors. If stock ABC comes out and says, "Hey, we think we're going to grow earnings at 9%," but the market had earmarked they think it's going to be closer to 15%, you're going to see a reaction in that stock, and so that's I think we always expect to see some of that.
Sure,
but beginning of the year, trying to kind of hammer in those expectations for what does 2026 earnings look like.
Yep.
Like you said, this is a big earnings moment, especially with
big
all
data
the,
points.
with all the themes we just talked about for 2026. All of that's playing in investors' minds as well, and people are listening to that. So
Yeah.
yeah,
And for those that listen to the entire podcast here, I'll give them a nice little cheat that I like using during earnings season. Not a recommendation for or against these two names, but check out the earnings for like a Visa or MasterCard. Not about those two companies, but their look through to the American consumer. Both of those companies have access to all the different consumer spending bands. And they tend to do a pretty good job when they report earnings, conveying the underlying spending trends that they're seeing. So again, not a recommendation for or against Visa or MasterCard, but rather the insights they provide on the consumer coming up here in a couple of weeks. That's juicy research if you're a Wall Street cat.
yes, that's a great point.
All right. Well, thank you for listening to episode 333 of the Independent Advisors Podcast. Me, Nick, Jenna, Mark, Taylor, Aaron, rest of the team, appreciate you listening. Catch us next week for episode 334.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.